What if I told you that the secret to successfully profiting from market movements isn't better math, faster data, or a complex algorithm? What if the key lies simply in understanding the deepest flaws of the person looking back at you in the mirror? We spend countless hours studying balance sheets, economic reports, and price charts, searching for the logical pattern that dictates where a stock will go next. But the truth is, beneath all the technical jargon and financial models, the market is driven by something primal: the powerful, cyclical forces of human greed, fear, and crowd behavior. The market is a psychological machine that harvests capital from the impatient and the emotionally undisciplined. To master the market, you must first master the memory and momentum of your own mind. Welcome to Capitura. Today, we're not just exploring the psychological pitfalls of investing. We're learning to build an internal shield against the manic chaos of the crowd. We are going step by step through the timeless masterwork of technical analyst Martin J. Pring, Investment Psychology Explained, Classic Strategies to Beat the Markets, the author and his technical wisdom. Martin J. Pring is best known as one of the world's leading technical analysts, famous for his books on market cycles and charting techniques. Unlike pure behavioral economists who focus only on academic theory, Pring's perspective is that of a pragmatic chartist who has spent decades observing how human emotion manifests directly on the price chart. His core insight is that technical patterns are simply psychological patterns recorded visually. Every rally is a monument to collective greed. Every crash is a canyon carved by universal fear. Investment Psychology Explained is Pring's bridge between his technical expertise and the underlying human behavior. He argues that an investor can possess the perfect technical system, the best indicators, the sharpest market timing model. But they lack the emotional discipline to follow the system. They are doomed to fail. The ultimate technical obstacle is internal, not external. Why Pring's lessons are critical today. Pring's original work predates the age of the smartphone, yet his principles are more relevant now than ever. The modern market is an accelerant for the exact emotional flaws he details. The speed of contagion. In Pring's day, herd mentality spread via newspaper and word of mouth. Today, the spread of FOMO, fear of missing out, is instantaneous, amplified by social media platforms and trading apps. A speculative frenzy that once took months to build can now peak in a week. Meme stocks and crowd mania, the spectacular rise and fall of GameStop, or Dogecoin are perfect case studies in pure, unadulterated crowd mania. These movements were driven entirely by shared euphoria, memory of past gains, and the psychological momentum of the herd, exactly the forces Pring details. The FIRE movement and discipline. Even those pursuing disciplined strategies like financial independence, retire early FIRE, face the ultimate Pring test. It's not the savings rate that breaks the plan. It's the emotional failure to stay invested when a multi-year bear market hits and fear becomes contagious. Pring provides a necessary antidote, a rigorous, almost clinical focus on discipline, patience, and the statistical reality of cycles. He teaches us to recognize the 7 deadly sins of investing and establish the psychological rules that will save us from our own impulsive nature. Stay with us as we break down this essential guide to internal market mastery, teaching you how to step outside the madness of the crowd and use its predictable behavior to your advantage. Chapter 1. The Emotional Cycle of the Market. Pring begins by establishing the fundamental truth of the market. It moves in predictable, recurring cycles, and these cycles are primarily driven by the pendulum swing of human emotion. The anatomy of the emotional cycle. The market cycle is a story told in 4 repeating acts, each defined by a dominant emotion. The accumulation/base phase, skepticism/fear. This phase occurs after major crash or long bear market. Prices move sideways. Sentiment is overwhelmingly negative, and the memory of the loss is fresh. Only the most patient, contrarian investors and large institutions are buying. The dominant emotion is skepticism, rooted in fear. The advancing/public participation phase, hope/optimism. The price breaks out, confirming a new bull market. Early investors feel hope, which slowly turns into widespread optimism as more people join. This is the longest and often most profitable part of the cycle, characterized by steady momentum. The distribution/euphoria phase, greed/mania, the price accelerates rapidly, driven by media hype and retail participation. The emotion shifts from optimism to greed and outright euphoria. The belief is that this time is different, and prices will rise forever. Smart money begins to quietly sell-distribute their holdings to the irrational crowd. The declining/panic phase, denial/panic prices begin to fall, initially met with denial. It's just a correction. As the drop accelerates, denial turns to sheer panic and despair. This phase is fast, violent, and characterized by the emotional selling of good and bad assets alike. Pring emphasizes that this cycle is self-perpetuating. The memory of the crash fuels the skepticism of the base, and the memory of the rally fuels the greed of the peak. The single greatest mistake an investor makes is to allow their personal emotional state to match the dominant emotion of the market phase. Modern investing application. The market's emotional cycle is visible in every major asset class, especially the newest and most volatile. The Bitcoin cycle. The emotional swing of Bitcoin perfectly maps Pring's cycle. Base phase. The long crypto winter after crash, where only the core believers are left skepticism. Euphoria phase. The parabolic rise fueled by nonstop media coverage, where taxi drivers and grandmothers ask if they should buy greed/mania. Panic phase, the sudden, rapid 50% plus correction where social media is flooded with despair, panic. The role of the media. The financial media is a crucial amplifier of the emotional cycle. Media coverage is minimal and pessimistic in the base phase, and overwhelmingly optimistic and breathless in euphoria phase. An intelligent investor uses the media as a contrarian sentiment indicator. When a positive narrative is simple, universal, and aggressive, it's a sign the emotional peak is near. The key lesson of Chapter 1 is to identify the phase of the cycle. If everyone around you is giddy with success, it is time to be fearful. If everyone is paralyzed by fear, it is time to be greedy. The market demands a contrarian emotional response. Chapter 2. The herd instinct and the psychology of crowds. Building on the emotional cycle, Pring tackles the most dangerous force in the market, the herd instinct. Since humans are social animals, the urge to conform and seek safety in the crowd is immense. But in finance, this conformity is lethal. The comfort of conformity. The herd instinct is a deep-seated survival mechanism. If 100 people are running from a perceived danger, the safest immediate choice is to run with them, regardless of whether the danger is real. In the market, this translates to, when everyone is buying, it feels safe to buy. When everyone is selling, it feels dangerous to hold. The illusion of validation. When an investor buys a popular stock, the subsequent rise in price acts as powerful positive reinforcement. This confirms their decision was right, making them less likely to question the wisdom of the crowd later. The fear of being wrong. FOMO, the greatest psychological pain for the amateur investor, is not losing money. It's the fear of missing out, FOMO, which is the fear of being wrong and alone while the herd gets rich. This fear pulls people into market at the peak of the euphoria phase, precisely when they should be selling. Pring uses charting to demonstrate how the herd acts. Long, slow accumulation periods when the crowd is absent are followed by sudden parabolic moves when the crowd rushes in. The crowd arrives late and leaves late, always selling to the smart money at the bottom and buying from the smart money at the top. Modern investing application. The herd instinct is amplified to an extreme degree by modern digital platforms. Robinhood and social validation. The gamification and social features of trading apps encourage immediate, impulsive conformity. Trading leaderboards, top movers lists, and confetti animations for trading provide continuous positive reinforcement for herd activity. This removes the psychological friction that would otherwise force an individual to question the wisdom of the crowd. Meme stock coordination. The meme stock phenomenon is the purest, most coordinated expression of the herd instinct ever recorded. Social platforms created a digital echo chamber where skepticism was instantly silenced, and the collective euphoria and short-term momentum, Joseph effect in Mandelbrot's terms, became the only rationale for buying. It was a collective psychological momentum trade, not an investment. The contrarian signal. Pring's work provides a clear mandate. The intelligent investor must learn to use the sentiment of the crowd as a contrarian signal. When everyone you know is talking about how easy it is to make money, that is the single most compelling evidence that you should be exiting the trade. The lesson of Chapter 2 is that your greatest advantage is the ability to stand alone. The surest path to financial failure is to seek comfort in the consensus. Market success requires psychological isolation. Chapter 3, the role of memory and expectations. This chapter explains how the market's emotional cycles, Chapter 1, are fueled by the memory of past experience and the resulting expectations. This is a psychological mechanism that enables a Joseph effect, the persistence of trends, memory and anchoring. Pring notes that the memory of two key events constantly distorts current judgment. Memory of pain, the memory of the last crash or recession. This lingering fear keeps prices low and skepticism high in the base phase, preventing investors from buying when assets are cheap. Memory of profit, the memory of the last spectacular rally. This leads to anchoring, as explored by Kahneman, where investors assume the past gains or prices are the new normal. This memory creates the anchoring effect. When a stock that once traded at $100 falls to $50, the investor is anchored to memory of $100. They feel the need to hold the stock until it gets back to that arbitrary anchor, which is a psychological, not a financial, goal. Expectations and emotional fuel. Memory directly fuels expectations. Expectation of gains. The memory of a long bull run leads to the expectation of inevitable, quick, and continuous gains. This belief accelerates the euphoria phase. When the gains finally slowed down, investors panic because of reality, slowed growth, violates their expectation, parabolic growth. The role of the recent past. Pring emphasizes that the market's short-term memory is overwhelmingly dominated by the most recent past. A long history of slow, steady returns is quickly forgotten in favor of the last 3 months of spectacular, euphoric returns. This short-term memory loss is what enables the massive overvaluation at the market peaks. Modern investing application. The power of memory and anchoring is amplified by easily accessible historical data. The Tesla anchor. Early investors in Tesla who bought at $100 and watched it soar to $1,000 are often psychologically anchored to the higher price. If the stock falls to $500, they might resist selling, even if the fundamentals justify it, because the memory of the $1,000 price becomes the anchor for its perceived true value. This is a rational holding driven by memory and the loss of a past high-to-fire movement and market correction. Long-term investors who have only experienced a prolonged bull market are anchored to the memory of high annual returns, e.g., 15%. When a correction hits and returns drop to the historical average, e.g., 7%, the investor is likely to feel excessive fear because the lower return violates their memory-driven expectation. This anxiety can lead to premature, irrational selling, confusing a normal correction with a catastrophic failure. The key lesson of Chapter 3 is to base decisions on the future, not the past. Your system, too, must be trained to ignore the arbitrary price anchors of memory and rely only on the objective analysis of a company's future value. The past price is irrelevant to the future decision. Chapter 4, the vicious cycle of fear and greed. This chapter is a deep psychological exploration of the two most powerful emotions in finance, fear and greed, which act in a self-destructive feedback loop. Greed, the addiction to winning. Pring describes greed as a desire to make the maximum amount of money in the minimum amount of time. The behavioral risk, greed leads to two fatal behaviors: chasing momentum and over-leveraging. An investor chasing greed buys into the market late, at the peak of the euphoria phase, because they are desperate not to miss the final, fastest gains. They use leverage borrowed money to amplify returns, ignoring the potential for loss. Greed makes the investor forget the possibility of loss aversion. The psychological hook, a small, early win acts as powerful positive reinforcement, increasing the investor's self-confidence, illusion of control, and leading them to take larger and larger risks. Fear, the urge to escape. Fear is a natural, acute reaction to the threat of loss. The behavioral risk. Fear leads to the most damaging behavior, panic selling. The memory of pain, Chapter 3, causes investors to sell out of the market during the panic phase, realizing permanent losses to escape the temporary, overwhelming psychological pain of uncertainty. Fear makes the investor refuse to buy when assets are cheapest. The fear/greed feedback loop. The two emotions are linked. Greed at the peak creates the overvaluation that makes the subsequent crash and fear inevitable. The fear of missing out at the bottom turns into the greed of getting rich quick, and the cycle repeats. Modern investing application. Fear and greed are accelerated by instant access to trading and price data. The 24/7 market. In the past, the market closing provided a psychological firewall against panic. Today's 24/7 crypto and stock markets mean the fear/greed loop is continuous. A sudden drop overnight can trigger immediate, emotional selling at 3 a.m., driven purely by panic, with no time for System 2 rationalization. The passive investor's test. The long-term passive investor faces the ultimate test during a severe bear market. The drop in their account value triggers overwhelming fear. Their System 2 plan says keep buying, but their System 1 is screaming escape. The ability to mechanically follow the plan is the only defense against the primal urge to panic. The antidote. The trading plan. Pring's solution is the unemotional trading plan. All rules for entry, when to buy and exit when to sell, must be established before the trade is executed. This is the only way to replace the emotional decisions of fear and greed with the cold, statistical logic of the system. The core lesson of Chapter 4 is that your investment strategy must be a psychological defense mechanism. It is a set of rules designed to keep you emotionally detached and to force you to execute actions that are the inverse of what the crowd's fear and greed are dictating. Chapter 5. Why We Lose Money. The 7 Deadly Sins of Investing. Pring distills the core behavioral failures into a succinct list of 7 deadly sins. This chapter serves as a comprehensive checklist for self-sabotage. The 7 sins behavioral traps. Trading too frequently. High activity, often fueled by boredom or the urge for quick profit, leads to high transaction costs and constant exposure to the emotional noise of the short term. Lack of discipline. Deviating from a pre-established plan based on emotional impulses, e.g., selling a winner too soon or holding a loser too long. Ignoring risk control. Position sizing, taking excessively large positions in single stocks or using too much leverage. This is a direct consequence of greed and the illusion of control. Averaging down badly. Buy more shares of a losing position in a desperate attempt to lower the average cost and get back to even. This is driven by anchoring in the sunk cost fallacy. Letting losses run. The inability to cut a losing trade short due to loss aversion. The pain of realizing a loss. This is the most common and destructive failure. Chasing tips and hype. Ignoring your own analysis to follow a rumor or media frenzy. This is a herd instinct, Chapter 2, overriding rational thought. Failing to act on the buy signal. The inability to buy when the signal is given, usually during the panic phase, due to lingering fear and the memory of pain. Pring emphasizes that the most damaging sin is not any single technical mistake, but the lack of discipline that allows these sins to be repeated. Modern investing application. The 7 deadly sins are accelerated by today's commission-free environment. Sin 1. Trading too frequently. Commission-free apps have eliminated the financial friction that once punished frequent trading. This encourages overtrading, turning investing into a form of gambling and maximizes the investor's exposure to their own emotional flaws. Sin 4. Averaging down badly. Meme stocks. The meme stock phenomenon saw massive numbers of retail investors committing this sin. As a stock like GameStop plummeted, investors bought more and more, anchored to the past high price and desperate to save the original investment, sunk cost. The attempt to save a small loss resulted in a catastrophic loss. The solution, a system. The only defense against the 7 deadly sins is the unwavering adherence to a clear system. For a passive investor, the system is buy a low-cost index fund automatically every month, regardless of market price. This simple rule immunizes the investor against almost all 7 sins. The core lesson of Chapter 5 is that success in investing is not about being a genius, but about avoiding stupidity. The intelligent investor focuses on the consistency of the process, not the brilliance of prediction. Chapter 6. The essential role of discipline. If the previous chapter listed the sins, Chapter 6 provides a salvation, discipline. Pring argues that discipline is not just a virtue. It is the single most important non-negotiable trait required for consistent long-term success. Discipline as a mechanical system. Pring defines discipline as the ability to substitute a reasoned, objective, predetermined rule for an emotional, subjective impulse. It is the power of the system 2, the slow, rational mind, to override the system 1, the fast, emotional mind, in the moment of crisis. The firewall, a written, detailed trading plan, acts as an emotional firewall. It forces the investor to confront market decisions logically when they are calm, not emotionally when they are in a state of fear or greed. Key disciplines. The plan must include explicit rules for the most emotionally difficult decisions: entry, position sizing, and exit. Entry, only buy when a specific predefined indicator signals value. Position sizing, never allocate more than a small, predefined percentage of capital to any single trade. This is the ultimate defense against greed. Exit, stop loss / take profit, establish a specific price at which a loss will be realized, stop loss, and a price at which a profit will be taken, take profit, and execute them mechanically, the pain of correction. Pring notes that the failure to apply discipline is not a moral failing. It is a lack of willingness to endure the short-term pain of being wrong. Cutting a loss is painful. Being wrong while the crowd gets rich is painful. Discipline is the capacity to endure that immediate psychological discomfort for the sake of long-term financial survival. Modern investing application. Discipline is a defense against the speed of the modern market. Automation is discipline. For the vast majority of investors, the most powerful act of discipline is automation. Setting up automated monthly investments into a diversified portfolio removes the emotional impulse from the buy decision. The decision is made once, System 2 planning, and executed mechanically forever. The write-it-down rule. Active traders should adopt the rule of writing down the rationale for a trade before execution. This forces a momentary activation of System 2. After the trade is done, they can look back and see if they adhere to the original, rational plan or deviated due to emotional impulse. The stop-loss evasion. The failure to use a stop-loss order is a common failure of discipline. Traders often manually remove a stop-loss when a stock approaches the exit point, hoping for a bounce, thereby letting a small loss become a huge loss. This is loss aversion, defeating discipline. The key lesson of Chapter 6 is simple. Discipline is a single factor that separates consistent winners from inevitable losers. The process is paramount. The outcome is secondary. Chapter 7. The Investor versus the Trader. Pring draws a crucial, clear distinction between the investor and the trader, arguing that the two require fundamentally different psychological profiles and strategies. Conflating the two roles is a common path to failure. The investor, the psychological long hauler. Goal, long-term capital appreciation. Focus on a business's fundamental value. Psychological profile requires patience, emotional detachment from short-term noise, and humility, acknowledging the market is chaotic. Strategy, buys and holds, uses dollar-cost averaging, and ignores the emotional cycle of the market. Their time frame is years or decades. The trader, the psychological short hauler. Goal, short-term profits from price volatility. Focus on technical momentum and herd sentiment. Psychological profile requires ruthless discipline in cutting losses, emotional agility, the ability to admit quickly they are wrong, and zero attachment to any single asset. Strategy uses strict entry/exit rules, stop losses, and leverage. Their time frame is hours, days, or weeks. The fatal error, mixing the roles. The most dangerous investor is the one who becomes a forced long-term investor. They intend to be a short-term trader, buying a volatile stock with short-term profit goal. When the trade moves against them, they fail to cut the loss, lack of discipline, and they rationalize, "I'll just hold it for the long term now." They have transformed a speculative trade into a long-term investment, which is a massive failure of planning and discipline. Modern investing application. The modern market blurs the lines between these two roles dangerously. The Robinhood identity crisis. Trading apps encourage the behavior of a short-term speculator, high-activity, hype-chasing, but with the capital of a long-term investor. The easy access creates millions of people who are psychologically unprepared to be traders, but are too active to be true investors. The FIRE investor is a true Pring investor. The long-term investor following a FIRE strategy is the purest form of Pring's ideal investor. They are patient, disciplined, and ignore the short-term emotional cycle. Their focus is purely on the fundamental, long-term persistence of the global economy Joseph effect. They succeed precisely because they have the correct psychological profile for their long-term goal, the separate account rule. Pring would recommend that anyone who wants to trade should keep a small, separate speculation account. This enforces narrow framing on the speculative money, protecting the core, long-term investment portfolio from emotional leakage. The rest of the money must adhere to the strict, disciplined rules of the investor. The lesson of Chapter 7 is, know who you are and stick to your lane. Never allow a failed trade to become an unintended long-term investment. Chapter 8. The Power of Contrarian Thinking. Pring dedicates this chapter to the critical skill of contrarian thinking, arguing that consistent outperformance requires the ability to reject the emotional consensus of the crowd. Consensus is the enemy. Since the herd instinct, Chapter 2, drives a market to extremes, consensus is almost always wrong at the pivotal turning points. The peak. At the peak of the euphoria phase, sentiment is universally positive. No one is left to buy. The contrarian should be selling. The trough. At the trough of the panic phase, sentiment is universally negative. Everyone is already sold. The contrarian should be buying. Pring uses technical indicators, specifically sentiment gauges, e.g., put/call ratios, bullish/bearish survey data, to measure the crowd's emotional consensus. When the data shows excessive bullishness, too much greed, it's a sell signal. When it shows excessive bearishness, too much fear, it's a buy signal. The psychological barrier to contrarianism. The true difficulty of contrarianism is psychological. Isolation and fear. Buying when everyone is in panic and despair requires immense psychological resilience. It means being alone and facing the high probability of short-term losses, no effect. The comfort of validation. Selling a winner while the price is still soaring requires resisting the massive positive reinforcement of the herd. It means accepting that you will be criticized and temporarily proven wrong. Contrarian thinking is the ultimate test of the investor's emotional discipline. Modern investing application. Social media makes contrarian thinking harder, but more valuable. Social media as a sentiment gauge. Today, social media is the most direct measure of herd consensus. When a stock is trending universally, e.g. Tesla or a hot technology, and the comments are overwhelmingly euphoric, it is a flashing red signal that the Joseph effect trend is overextended and a no-effect crash is increasingly probable. The value investor's contrarianism. The successful value investor is inherently a contrarian. They buy a good business at a cheap price because the market, the crowd, has temporarily succumbed to fear or neglect. Their margin of safety is a financial recognition of the market's overreaction. They are exploiting the inevitable correction of the herd's emotional extreme. The long-term buy signal. For the passive investor, the contrarian signal is simpler. When a market has dropped substantially, the panic phase, and every headline is negative, the disciplined choice is to keep buying or accelerate buying. This is the ultimate contrarian act. The key lesson of Chapter 8 is that profit is found at the extremes of emotion. To buy low, you must buy from the fearful crowd. To sell high, you must sell to the greedy crowd. Chapter 9. Behavioral Traps and Cognitive Biases. This chapter focuses on specific, recurring cognitive biases that derail rational investment decisions, aligning Pring's practical observations with the findings of behavioral economics. The biases that steal profits. Pring details several cognitive traps. Confirmation bias. The tendency to seek out and focus on information that confirms an existing belief. Once an investor buys a stock, they will read only the bullish reports and ignore the negative data, reinforcing the illusion of control. Hindsight bias. The belief, after an event has occurred, a crash or a rally, that was obvious and inevitable. This prevents learning from past mistakes and reinforces the investor's belief in their own predictive skill. Recency bias. The tendency to overweight recent information. A few months of stellar returns are given more weight than decades of historical data, leading to excessive risk-taking. Availability heuristic. Overweighting information that is easily recalled or highly visible, e.g. news headlines, successful anecdotes. This fuels the herd instinct and FOMO. These biases allow the emotional cycle, Chapter 1, to operate unchecked. They create the psychological conditions for irrational exuberance and paralyzing fear. Modern investing application. The cognitive biases are constantly reinforced by today's curated news feeds. The curated echo chamber. Social media algorithms and personalized financial news feeds feed the confirmation bias. If an investor holds Tesla, their news feed is optimized to show bullish articles and filter out skeptical analysis, creating an emotional echo chamber that validates their position. Recency bias and index fund evasion. After a decade where growth and technology stocks delivered spectacular, high-return Joseph effects, many investors abandoned diversified, long-term strategies. The recency bias made them overweight the last 5 years of returns and ignore the long, historical memory of cyclical downturns, leading to overconcentration in expensive growth stocks. The antidote. The checklist. The only way to counter cognitive biases is through a rigorous, mechanical process. Chapter 6. A disciplined investment checklist that forces the investor to confront negative data, disconfirming evidence, and historical base rates is the primary defense. The core lesson of Chapter 9 is that the human brain is wired to make investment mistakes. Success requires the conscious, mechanical imposition of a disciplined system to override the brain's natural tendencies. Chapter 10. The role of luck and probability. This chapter brings a dose of realism to investing, focusing on the inevitable role of luck and the need to ground all decisions in statistical probability. Luck versus skill. Pring argues that in the short term, luck plays a far greater role than most investors are willing to admit. The illusion of skill, a string of short-term wins, is often due to pure luck, random variation. The investor attributes these wins to personal skill, reinforcing the illusion of control and leading to increased risk-taking. A subsequent string of losses is then attributed to external bad luck. The need for large samples, consistent, demonstrable skill can only be separated from luck over a large sample size and a long time frame, e.g. decades. The intelligent investor attributes short-term gains to luck and focuses solely on consistency of the process, grounding decisions in probability. The market, in Pring's view, is a game of probabilities. Risk management. The entire goal of a good trading system is not to achieve 100% certainty, but to ensure that the trades taken have a favorable risk-reward ratio and a high probability of success. The key is to manage the magnitude of losses when the low probability event occurs. The stop loss is a probabilistic tool. The stop loss is the ultimate probabilistic tool. It assumes the trade is wrong and sets a non-negotiable threshold for realizing a control loss. It protects the portfolio from the Noah effect's sudden, fat tail drop. Modern investing application. Luck and probability explain why speculative trading is often a negative-sum game. The lottery effect. Speculative assets like Dogecoin or out-of-the-money options are high-risk, low-probability bets. The investor is betting on luck. While the gain is spectacular if luck hits, the long-term probability is against them. The passive investor's probability. The passive investor relies on the highest probability bet in finance, the long-term growth of the global economy. By diversifying and holding for decades, they are betting on the only outcome that is a near 100% historical probability of success. They have optimized their strategy to rely on a high probability outcome, minimizing the reliance on short-term luck. The core lesson of Chapter 10 is that investing is not a game of certainties. It is a game of controlled probabilities. The intelligent investor's primary focus must be on managing the probability and magnitude of failure, not chasing the spectacle of a lucky win. Modern context expansion. If Martin J. Pring were to observe the financial markets today, he would be both fascinated by the technology and deeply concerned by the psychological reality. He would see the modern market as a perfectly designed emotional engine, accelerating every behavioral flaw he studied. The amplification of emotion and momentum. Pring's core concepts, the emotional cycle, Chapter 1, and the herd instinct, Chapter 2, are magnified exponentially today. Fractal momentum. Joseph effect. The speed of information and algorithmic trading means that the Joseph effect, the persistence of trends, is stronger and faster. When a positive sentiment takes hold, the resulting price momentum is amplified, leading to shorter, more violent bubbles. Pring would view platforms like Robinhood and Reddit as the ultimate catalyst for this collective momentum trade. The elimination of discipline by design. The combination of commission-free trading and instant notifications eliminates all the friction points that once forced discipline. The 5-second delay of calling a broker gave System 2 a chance to interject. The instant execution of an app removes that firewall. This environment encourages all 7 deadly sins simultaneously. Shield against FOMO, herd instinct. The core principle is contrarianism. When a stock is being universally hyped on social media, the herd instinct is at its peak, signaling the approaching euphoria phase and the inevitable crash. Shield against crash panic. Fear/memory, the defense against panic selling, is the unwavering mechanical rule, Chapter 6. The pre-established plan to buy or hold during the panic phase overrides a powerful memory of pain that is driving the crowd to sell. Shield against over-leverage. Greed, the discipline of position sizing, is a firewall. By limiting the risk allocated to any single trade, the investor prevents a single, emotionally driven, lucky win from fueling the greed that leads to massive future leverage losses. Pring would conclude that the modern market is terrifying because the psychological distance between profit and self-destruction has never been shorter. The more technologically advanced the market becomes, the more primitive and disciplined the successful investor must remain. We have explored the psychological battleground of investment psychology, explained, and learned that the most complex challenge in finance is not external data, but internal discipline. Success requires a capacity to act rationally when the world is screaming for you to panic. Here are 10 timeless lessons from Martin J. Pring for the intelligent investor. Be a psychological contrarian. Your emotional state must always be the inverse of the crowd's. Be fearful when others are greedy. Be greedy when others are fearful. Discipline is salvation. The unwavering adherence to a pre-established plan is the single greatest competitive advantage. This is the only way to replace emotional impulse with reasoned action. Cut your losses short. This is the most crucial discipline. Realize small losses quickly and ruthlessly to avoid catastrophic ones. Never allow loss aversion to defeat your stop loss. Know your role. Clearly define if you are an investor, long-term, fundamental, or a trader, short-term, technical. Never let a failed trade turn into an unintended long-term investment. Ignore price anchors. The memory of stock's past high price is irrelevant to its future value. Base decisions on future analysis, not past regret or hope of getting back to even. Avoid the herd. Consensus is almost always wrong at the pivotal turning points. Use social media and news hype as a signal of euphoria phase peak. Manage position size. Limit the capital exposed to any single asset or trade. This is the ultimate defense against the self-destructive effects of greed and the illusion of control. Avoid trading too frequently. High activity increases transaction costs and maximizes your exposure to your own emotional flaws. Simplicity and patience win. Attribute luck correctly. Attribute short-term gains to luck and focus only on consistency of your long-term process, the true skill. The plan is a firewall. All rules for buying and selling must be written down in detail when you are calm, to be executed mechanically when you are panicked or euphoric. How to apply these lessons right now. Automate your core portfolio. For your long-term savings, set up an automated, recurring monthly investment into a globally diversified, low-cost ETF. This is the simplest, most effective act of discipline. Institute the 2% rule. If you must trade, allocate no more than 2% of your total portfolio to the speculative account. This protects your core wealth from emotional leakage and enforces narrow framing on your risk. Use hard stop losses. Never enter a trade without a predetermined, non-negotiable exit price for realizing a loss. This mechanical rule overrides your loss aversion and prevents a controlled loss from becoming a catastrophic one. Pring's philosophy transforms investing from a gamble into a statistical science of self-control. It's a commitment to psychological resilience that is the only truly timeless edge in the market. And there you have it, the essential wisdom of Martin J. Pring's investment psychology explained. It's a powerful realization that the chaos outside your window is simply a reflection of the chaos inside your own mind. We hope this deep dive summary has given you the discipline to look past the market hype and build a simple, mechanical system that can withstand the inevitable swings of fear and greed. If you found value in this breakdown of investment psychology explained, make sure to subscribe Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be a disciplined investor.